a period where the markets are going to be hostage to the slightest incremental bit of information regarding the reactors, and that's
correct.
Not, and that's
correct.
That's going to be.
I think it's healthy that the markets start to focus on something else than what Mr. Bernanke is telling the press all the time.
I'm not sure what they'd rather look at, Bernanke's code or the news out of the reactors.
But speaking of Bernanke, Mark, is there any reason to think that the Fed's accommodative stance is actually extended because of the initial event in Japan, just the potential for the global economy being weaker than expected? Would it make it harder for the Fed to pull back?
I think it will make it harder, but I think they will pull back until the S&P drops from peak to trough. In other words, we were at 1344. That was the high in February. And we may drop 10, 15%, and then QE3 will come, and QE4, QE5, QE6, QE7, whatever you want. The money printer will continue to print, that I'm sure.
So then you don't expect that's interesting then. So it's not necessarily the worries about global growth, but it's based on where the S&P is, on whether the Fed continues to.
Yeah, I think Mr. Bernanke doesn't know much about the global economy, but he watches probably the S&P every day.
Oh. So you went all. What did you get to? QE8. I don't think anyone talked about QE8 yet, Mark. But I understand. You're somewhat tongue in cheek, but you don't expect June to be the end of the bond buying for the Fed.
Temporary. They will probably stop to, test the markets, how the market reacts. But afterwards, I would fully expect more quantitative easing. There's nothing else they can do, actually.
Go ahead.
I was going to say, Mark, obviously for U.S. equities, does it now seem ludicrous to talk about a slightly improving jobs picture here, or does that still matter?
I think that in general the economy bottomed out and that we are in a mild recovery. The outlook for employment is not particularly good, but I think there can be an improvement. But markets are a discounting mechanism, and we've already doubled in the S&P from the lows. So on the improvement, maybe the market sells off.
Hey, Mark, what about commodities? And I see two opposing forces in what you're talking about. Number one is that if asset values come down, even when you're talking about stocks and equities, that will throw a scare into the growth prospects for the globe. So I could see commodities coming down based on that. But you also think that the printing is going to continue full bore, so that'd be the opposite. But what do you think happens to commodities and oil?
Well, first of all, we have many different commodities, so each commodity is in a different position. In general, say, a nuclear meltdown or the accident that happened in Japan at the nuclear reactors is mildly positive for coal and oil, and negative, obviously, for uranium. And in terms of oil, I still think, from a risk-reward point of view, it's a very attractive commodity because either you're very bullish about the world and everything is Goldilocks and everything recovers globally, the emerging markets grow, Japan, because of the reconstruction work, grows again, the U.S. grows, and so forth and so on. So the demand for oil goes up and the supplies can't keep pace with the demand. Or you take an ultra-bearish scenario like I do, where you think everything will collapse and that there will be World War III and collapsing countries in the Middle East, and then the supply will be curtailed and prices will go up. So in either scenario, you're probably okay in oil.